In January 2025, the incoming administration invoked the International Emergency Economic Powers Act to impose immediate tariffs on Chinese, Mexican, and Canadian imports. By early April, a date the White House labeled Liberation Day, the executive branch expanded these measures into a broader regime of reciprocal tariffs. This was followed by a wave of Section 301 investigations. These probes targeted industrial subsidies and manufacturing overcapacity, signaling a shift toward using trade law as a physical barrier against the exports of major allies and adversaries alike. This chart shows the internal friction created by these policies. While the stock market reacts with short-term volatile spikes, domestic business investment outside of the artificial intelligence sector has effectively flatlined for over a year. Capital is not flowing into new factories or expanded production. Instead, investors are parking cash in short-term safe havens, pricing in a future of permanent policy uncertainty rather than industrial growth. Many economists describe this aggressive America First posture as a sudden departure from the global order. However, that perspective miscalculates the long-term trajectory of American history. The era of American-led free trade that defined the decades following World War II is a historical anomaly. For most of its history, the United States operated as a protected, developmental state, utilizing strategic isolation and high trade barriers to build its national strength. The executive branch is now executing the same 19th century playbook that originally built the American industrial base. This strategic pivot changes the basic bargain of American hegemony. After decades of providing the insurance that underwrites global stability, the U.S. is now leveraging the threat of its own economic volatility to extract specific, localized concessions from the rest of the world. This reversal threatens to dismantle the precise financial mechanisms that actually fund modern American geopolitical power. This data reveals the true baseline of the American economy. From 1820 through the early 1900s, the blue area, representing customs duties, tariffs on imported goods, was the primary source of revenue for the federal government. This began with Alexander Hamilton's 1791 Report on Manufactures. He argued that a young United States could only achieve independence by using tariffs to incubate domestic industry, shielding it from the commercial dominance of European empires. The 1861 Morrill Tariff solidified this developmental agenda. Under the Lincoln administration, the U.S. erected a massive protective wall for northern manufacturers, allowing domestic steel and textile mills to achieve massive scale without foreign interference. Before the introduction of the federal income tax, these tariffs were the literal lifeblood of the state, consistently providing between 50% and 90% of all federal income. This protective era reached its logical and disastrous peak under the Hoover administration, with the 1930 Smoot-Hawley Tariff Act. Designed to rescue domestic farmers and factories, the act pushed average tariff rates towards 60%. It triggered immediate, aggressive retaliation from every major trading partner. International commerce froze. While it did not cause the initial crash, Smoot-Hawley is credited with deepening the Great Depression, turning a domestic downturn into a decade-long global collapse. The 19th century American system used high walls to build an industrial giant. But when that giant tried to lock its doors during a crisis, it paralyzed the entire world. The shift was immediate. At the end of World War II, the United States abandoned its 150-year-old playbook. Revenue from tariffs effectively vanished from the federal budget, replaced by income and Social Security taxes. Post-war planners faced a dilemma. As the world's strongest power, the U.S. would inevitably be targeted by a coalition of lesser nations, unless those nations felt they benefited from American strength. The solution was the Bretton Woods system. The U.S. offered the world a deal. It would stop protecting its own markets and instead start protecting everyone else's. The United States became the world's genuine insurance company. It provided the security and rules that allowed the global economy to function. The U.S. military secured the shipping lanes, courts enforced international property rights, and the Treasury provided a safe haven for global savings. In return, the U.S. collected massive premiums that were largely invisible to the public. Global demand for the dollar became insatiable, as every nation needed greenbacks to participate in this secure system. This constant inflow of global capital lowered American borrowing costs across the board. It funded the government's deficits and made low-interest 30-year fixed mortgages a standard feature of American life. By acting as the global underwriter of stability, the U.S. captured financial benefits that fueled 80 years of unparalleled domestic prosperity. The recent return to aggressive tariff regimes and the weaponization of energy exports marks an explicit rejection of that insurance model. This shift moves the U.S. toward a model of extraction. By creating constant threats of economic disruption, the administration functions less like a systemic insurer and more like a protection racket, trading long-term global trust for immediate short-term concessions. Trust was the glue of the global system. Without it, efficient, centralized supply chains are shattering into localized, disconnected nodes, as nations realize they can no longer rely on a predictable American market. Allies are now forced into the massive inefficiency of building artisanal little screw factories, creating redundant manufacturing for every basic component just to avoid a single point of failure in a capricious U.S. trade policy. This creates an environment of absolute uncertainty for capital markets. When the rules can be rewritten by executive order on a Liberation Day, the risk becomes impossible to calculate. This explains the stall in long-horizon investment. Outside of the speculative AI boom, businesses are refusing to commit capital to a world where the guarantor of trade has become its greatest source of volatility. By destroying market predictability, the U.S. is incentivizing its own allies to de-risk and decouple from the American economy. The core failure of this new protectionism is a miscalculation of scale. In the 19th century, the American system worked because the U.S. was a rising power with an untapped domestic frontier. It could thrive by building walls and growing inward. Today, the U.S. is the linchpin of a hyper-connected global system. Raising walls doesn't protect the system. It causes the system to route around the U.S. entirely, cutting off the very capital flows that sustain American debt. As economist Adam Posen notes on the cost of this transition, we all get poorer faster in the way that we got richer faster. A world of fractured trust and forced self-sufficiency is a world of higher inflation and permanently disrupted energy markets. The United States is trading the foundational, unpriced wealth of global hegemony for the localized illusion of a tariff wall, a move that sacrifices the true source of its power for a temporary political win.